Hello, welcome to Benka's funding series part 2. I know it's a bit gap with the festivities and all, so I'll just take you for a glimpse of what the startup journey which I've discussed last time. The red one is the early stage, and the blue one is showing the growth stage, and the green is the later stages of funding. So the initial stage where it is the early stage is what we call where the self-funding is there, and the family, friends and family, angel investors. Mostly it is up till 2 crores, usually the funding, or more till 5 crores. So the it takes with an idea and concrete that idea with the personal investment, and then after bootstrapping, then go for the assemble, where you are pitching your idea, sell your idea, and come with the ask for the angel investor to create a model or to develop a model. Once you come for the developing a model with the proof of concept and also a POC, you'll come up to you'll strengthen yourself, and you will, if you have a co-founder before, it is well and good, or else you can attract more co-founders to come in, so that you are strengthening the company's portfolios. Then you are building your team. This is the part where you are ready for the ask for the next series, where you are securing the series funding, where the growth stage starts, where you want to expand the production, and also you want to go for the venture fundings for additional services or diversification. And then you will go for the validating the series B, where you are expanding, exploring growth and sustainability with a larger profit, where the equities are split in different venture capitalists, or a single investor, or multiple investors who are coming in depending upon the ratios. And then comes the series C, is the later stages, where the funding, the VCs are coming in, hedge funds are coming in, and the IPO is also part of it with the exit. So this is what I have mentioned it in a nutshell. So when you are, every startup founder should understand the terminology and the formulas which are very important for the when they go for the investment. So let's see a few of the formulas which are basically very important, like simple capital planning formula, where it is where the required funding, total startup capital, working capital, cash flows, the break even point, and the gross profit margin are part of it, and the revenues are part of it. So we will see the RF, that is required funding, is equal to planned monthly expense into expense runway months minus current cash balance. This is the start of a company, where every person who is investing should have a plan made for monthly expense, and what is the runway months, how many months you are doing, and what is the minus the current cash balance, where do you stand. This is very important. Then comes the another important thing is total capital, the founder's investment plus borrowed investment, friends and family or investors equity, number of directors, and their investment will come in. Another important term in the basics are the working capital, current assets minus current liabilities. So this is this understanding is for the balance sheet. Everybody should understand what is the current assets they have, and what are the liabilities which they have on the with their startups. The cash flow, it is day-to-day cash flows, usually cash flows, inflows and outflows. Every rupee is counted, and usually the positive cash flow is the one it shows the company's business is sustaining, and negative shows it needs external funding, and somewhere this is not that attractive for any investor to come in. But still, if the product is promising and the runway is good, then they'll definitely look into. The cost and profitability formulas are very important. The next one, where the break-even point, BP, fixed cost by selling price minus variable cost unit, is very important. Means when is your product is ready, and how much you are selling for, and what is the variable cost per unit, no profit, no loss, where you are reaching the point, that is the break-even point. So that is one important thing. And gross profit margin is equal to revenue minus COGS by revenue into 100. So revenue is always the quantity sold into price per unit, and that's how many number of products is sold, and number of price per unit into price per unit gives you the total revenue of this. I use the term COGS. It is the cost of goods sold. So the beginning inventory means your cash inflow and outflow will have the inventory, which is the beginning inventory plus purchase during the period minus ending inventory. Beginning inventory always shows the start of the period. Purchases is a cost of procuring and manufacturing the one, and ending inventory is the value of unsold inventory at the end of the period. Means what is that which you have in the product unsold is also very important for the COGS. That is COGS. Then comes the another term, net profit margin. The NPM is net profit by total revenue into 100. So your total revenue is the number of products which you have sold, or the revenue which is generated from your sales. Equity split. The founders ownership is equal to founders investment divided by total capital into 100. That is the percentage you can how you calculate ownership. So how many number of owners are there, that much percentage is divided as per the equity. Burn rate is total cash spent divided by months of operation. Any investor will be keen on this, because your burn rate actually tells what is your runway. Cash in bank divided by months of the burn rate. This will show where you are, positive, negative, and how many months you can continue with the business. Means the sustainability is with the burn rate and the runway. Then comes the revenue growth rate. Growth rate is equal to current revenue minus previous revenue divided by previous revenue into 100. That is the growth rate. If you are telling that you are growing by such a percentage, then your current revenue minus previous revenue divided by previous revenue into 100 will give you the growth rate. Another one important terminology is EBITDA, earnings before interest, taxes, depreciation and amortization. So EBITDA is operating revenue minus operating expense, exclusive of ITTA. So EBITDA margin is EBITDA by total revenue to 100. These two are very important for any of your investments when you are going. The operating revenue minus operating expense. So it should always be positive. So your EBITDA is shows that what is the current expense runway on the burn rate. Okay, investors, now we have seen this, and now we will also see what are the investors driven ratios. Return on investment is the one which every investor will be keen on. That is net profit by investment cost into 100. So this is one important thing which the founder has to be ready. The ROI which it decides the investor's interest. Internal rate of return is one more most important thing. The discount rate at which of future cash flows are there. NPV is equal to sigma t is equal to 1 to n CT divided by 1 plus R over T minus CO. So let's see one example to understand. NPV is equal to 40,000 is your current value by 1.1 divided over 1 first year plus 40,000 1.1 over 2 is second year minus 10,000 is your CO, means the start of the capital which you have invested. So that will show that I'm showing it as 2 years only where it is positive. It's showing a 30,578. But if we continue with the same discount rate, and then if we go with that for the third year, it will go in negative, minus 578. That is feeble, but still it matters. So our discount value always should depend upon our selling price, depend upon our what is the NPV which we are doing. Okay, so the IRR depends upon the NPV discount rate as per the sales and your IRR. So IRR should be always see that it is positive. The payback period is equal to initial investment by annual cash flows. This is one more important thing where investors will be interested, that how much is the investment and when are they going to get the returns. Debt to equity ratio. This is total liabilities by shareholders equity. This shows how much the company is in debt and what is the ratio and what is the financial leverage and risk the company is carrying. Capital efficiency ratio is equal to revenue by capital invested. So this is also one of the important one where it shows how effectively the capital is used to generate the revenue. So investor will be very interested in to see the capital efficiency, how where you are spending, what is your plan, and how are you going to take it further. Here you need the mentors and also the investors intervention sometimes, if not every time, to detail it out and understand how you people are really spending the capital which the investor has invested. Then comes the market and performance matrix. The market and performance matrix usually shows the customer acquisition cost, CAC, that is the total marketing and sales expense divided by number of new customers acquired. So how are you growing? What is your growth in acquiring, increasing your customer base? This is where the CAC comes in, and investors really look for it, that how many customers you have at the time of investment and what is the plan you are taking up your strategy to expand your customer base. LTV and CAC ratio, that is CLV, is average purchase value into purchase frequency into customer lifespan. It is customer lifespan is how many AMC also comes in and how many times the customer is going to buy. That is again a consumer point of view, which is investors' interest. Indicates efficient customer acquisition and retention. Then comes the monthly recurring revenue, MRR. Usually it is seen in subscription based businesses, services and startups. And also the MRR is average revenue per unit into number of active users. And what is the period of users? That also matters here. So these are the terms when it comes to the investment planning, and being ready with this is important. Then how the investors will look into are the valuation multiples used by investors, that is P by E ratio, price per share divided by earnings per share, that is profit based evaluation. For that the investor is using this. EV by EBITDA, that is enterprise value divided by EBITDA, that is compares operating or profitability. Then EV by revenue is enterprise value by revenue, used for early stage startups. And then P by B ratio is price per booking value, that is capital by intensive firms. These are most important while they plan to invest. This is the clarity they'll get. Then the profitability and efficiency formulas, which are important, is operating margin. The operating margin is operating income by revenue into 100. The purpose is efficiency of operations. Net profit margin, as we have seen, net profit by revenue into 100. Overall profitability. Asset turnover is the revenue by total assets, is the asset efficiency. Working capital is current assets divided by current liabilities, that is liquidity strength. So this is an important journey any startup will take up. And next video will be on what is the trend and who are the investors in India, and currently how much is the investments are in. I know everybody will have access to internet, but I am trying to give a snapshot to understand and to complete the series of the funding series videos. Thank you.